Okay, welcome again. Let us see on drivers of market movement. Now, say according to technical analysis, there are two drivers of market movement. The first one is greed and fear. Now, say it is often said that stock prices are driven by two twin forces known as greed and fear. Now, greed, you say, is that the investor want to make more money. So, for investor, having greed to make more money, it is known as a greed. And the fear is that they fear that they may lose their money or they may make loss. That is known as fear. Now, these are two twin forces which drive market movement according to technical analysis. Now, so these two forces lead to support levels and resistance levels which limit the price movement until breakout of the current price range occur. Now let us see what is the support and what is the resistance level. Now support and resistance levels are price level at which the downtrend or uptrend in price movement is reversed. Now for support level, we say occur when the price is falling but bounce back or reverses direction every time it reaches at a particular level. That is known as the support level. Now say when all these low points are connected by horizontal line, it forms the support line or support level. Now say the support level acts as a floor and the follow when bargain hunters enter the market to support the price. That is the greed. Now say the resistance line occur when share price move upward. The price may fall back every time it reaches a particular level. A horizontal line joining these tops form the resistance level. Now say a resistance level acts as a ceiling and as it is reached, the selling occur. Profit takers who want to make profit in rising market fear that the market has risen too much and therefore they sell to avoid losses. Now say the support and resistance level are derived using a trend line. So if you join 2 or 3 previous peak will give a resistance level. If you join 2 or 3 previous trough, you will give the support level. So we will define what is the trough and what is the peak. Now we have a diagram which shows the support line and the resistance line. So you can see there is a price movement, ups and down movement in the share price. So initially, the red line, it was the support line when the prices was at this level. So it reached a point when the price black out and goes below. So this will change from being the support line, then it will become a resistance line. So after price goes below this level, so this price will go up this level where another support line will be formed with a green. So there is up and down movement to the price, where when it reaches this point, the price bounce and reverse, it will start going down again. When it rises and reaches this point, it bounce and reverse the direction, it start going down. So we have from this point, after this point, our red line, it was the support line. Now after the price break out and go below this level, then this line by red changed and it became the resistance line. So from this point, or from the month of October to April, from October year 2000 to April year 2001, the red line is the resistance line and the green line is the support line or support level. Now after that, let us move on trading on technical signal. Now say the technical signal can be obtained by calculating the moving average and plotting on the graph. So you calculate the moving average for a certain period of time and then you plot on the graph. Then when the shorter period moving average close the longer period moving average, you get either buying signal or selling signal. Now, say moving average, you say these are signals used to identify whether to buy or sell stock. There is some significant empirical evidence to support the profitability of this approach when the market is trending. So we say long and shorter moving average is calculated and drawn in the chart. Now the buying or selling signal will be generated when two moving average cross. These reflect changes in the price movement or price momentum in the market. Now let us see on how we can calculate. We say the simple moving average is formed by computing the average or mean price of security over a specified period of time. For example, you may have a 5-day simple moving average calculated and then plotted in the graph. So we have a 5-day and so you can see how you can calculate this 5 days simple moving average. So you calculate the return of shares for 5 days. So day 1 10, day 2 11, day 3 12, day 4 13, and day 5 is 14. So if you add, you get 60. So 60 divided by 5, you get 12. This is how you can calculate the simple moving average, or we can use the exponential moving average. Now, after we've seen how we can calculate the simple moving average, now let us see how the long-term price trend can be calculated and plotted in the graph to identify buying and selling signals. Now, for a long-term price trend, you can calculate the moving average for 50 days and 200 days moving average. Now here for 50 and 200, now the 50 days will be shorter and 200 days will be longer. Now say after calculating the 50 days moving average, simple moving average, and 200 simple moving average, if you plot on the graph, on a chart or graph, we say if a shorter moving average cut up the longer moving average, this is a signal to the start of bull market. So if the shorter cut above, it cut from below the longer moving average, so this is a signal for start of bull market. So it's a signal for buying. And if it cut down through the longer moving average, this is a signal for the start of bear market. So the start of bear market is a signal for selling, because in the future price will go down. So sell now to avoid future losses. Now, so this works because it identifies the changes in the momentum of price movement in the market. Now say this is because the shorter moving average reacts more quickly to the changes in price than the longer moving average. Now say we have a golden cross, which triggers when 50 days moving average break above, or it cuts the longer moving average from above. This is a signal for golden cross. Is the cross where you can generate profit. So we have a graph here where 50 days and the 200 days moving average are plotted. Now we have a red graph, which is the 200 moving average, and we have the blue, which is the shorter 50 days moving average. So at this point, there are some signals which can be generated, but there are no cross. But we have here this point with a green arrow. This generates information whether there is either buying or selling signals. So here you can see the shorter cut, longer moving average from below. So this is the signal for buying signal, or is a signal for the start of bull market. So you buy now and make profit when the prices rises. So golden cross, we say, The golden cross occur when 50 days moving average rises sharp and crosses over 250 days moving average. Usually, a golden cross is associated with a sharp upward price movement and can be used to buy signal in the belief that significant upward trend will follow. The reverse of event is known as the death cross, where 50 days moving average cut below the 200 moving average. This is a signal for bearish trend. Now we have a graph here where you can see the 50 days with red color. It cut from above, or it cut below the green, which is the 200 moving average. So now this is the signal generated here is the start of bear market. So you sell before price start going down. It is known as the death cross. Also, we can draw the moving average for 50 days, for 15 days. For 15 days. Also may have the moving average for 5 days and 14 days. Now this is known as the short-term price trend. Also, this is used to generate similar signal. Now we say for 5 days this is a shorter moving average and the 14 days longer moving average. Now say if shorter moving average cut up through the longer moving average, this is a signal for buying. If it cut down below the longer moving average, this is a signal for selling. So this is identify change in the momentum of price movement, because the shorter moving average react more quickly to the changes in the price trend than the longer moving average. Now we have a graph where you can see the graph, the moving average plot in the graph. Now we have the graph, the moving average, which have more ups and downs than the other. That is the shorter moving average. So we may have the red one, this is the longer moving average, and also we have the one with the green, this is the shorter moving average. So you can identify the buying or selling signal when the two graphs meet, when the shorter moving average cut the longer moving average. Now, so we have the graph that shows the ups and down movement. We have the one with the green and the other one with red. So you can identify buying or selling signal by looking when the two graphs meet. So you need to take into account to identify buying or selling signal when the shorter moving average cut when the shorter moving average cut the longer moving average. Thank you very much for listening.